The last couple of weeks, we've seen a lot of panic in the markets and a lot of people have been selling off in the markets, but we want to remember it's not timing the market that makes a difference. It's time in the market that makes the difference and makes you successful. And some people were a little bit nervous and some people may have wanted to sell. We usually want to wait for rallies to sell. And if you can't wait for a rally, maybe you can free up a little bit. Freeing up about 5 to 10% is much better than selling out of everything. If you have trouble sleeping at night, if you sell off maybe 5 to 10%, that may be a little bit that you move to cash that may help you be able to sleep at night. And we never want to sell 100% out of the market. On these rallies, we can free up some cash if the recent sell-off made you nervous. Warren Buffett had already freed up cash. He had more than a third of Berkshire Hathaway in cash. Over half of the marketable security portfolio he had in cash and treasuries before we even saw the sell-off. He likely was buying into the sell-off because we want to be buying when others are fearful, but we want to be fearful when others are greedy. So when everybody else was greedy, Warren Buffett was freeing up cash. Now, we want to wait for rallies to free up cash. And if you were a little bit concerned, then we can use this time to free up cash, move some into the money market, maybe even move some into gold. It's very interesting that this time around, gold is behaving a lot better than treasuries, better than cash. Gold is already hitting new all-time highs. Usually in bad markets, it's cash and treasuries, short to long-term treasuries and gold that hold up the best. This time around, it's the gold that's done the best, followed by the cash and the treasuries. We want to make sure that we look to potentially reduce the risk in the portfolio if this allocation that you have been in causes you a little bit of concern and you haven't been able to sleep well at night. We don't want to bother portfolio while it's down. When it's down, that's going to be the time when you want to buy, but we don't want to buy too much, because if we buy too much and we actually go into debt to buy, that can cause really bad problems. So sometimes people go and have too much on margin and the sell-offs really hurt them. Howard Marks, who I like personally as an investor, he's mostly a bond investor, but he says the best time to be buying is when people are forced to sell. And the best time to be selling is when people are forced to buy. Now, right now, people aren't being forced to buy, except in some rare cases where they're short. When things move up a lot and you have people that are short, we have really big up moves, those are good times to be selling potentially, but we want to be selling when we're hitting new all-time highs, typically more so than just coming off the lows. So we want to be buying when people are forced to sell. Those are the very best times to be buying. And those people that are on margin are usually the ones that are the forced sellers, and we don't want to be one of those people. Now, one thing that we always want to keep in mind is our family index number, and that family index number is the return that we have to get in order to achieve our goals. So if you need to take on a little bit more risk than maybe you're super comfortable with to achieve your goals, we want to make sure we're taking on at least that amount of risk. But looking at this over time, sometimes as we get more comfortable with what we're invested in and understand what we're invested in a little bit more, we're able to take on a little bit more risk and we get more comfortable with this. But one thing to keep in mind is don't look at your investment portfolio too much, because those people who look at it every day are the ones that go crazy the most. If you're looking at your investment portfolio, say once a month, that's usually okay. If maybe look at it once a quarter. But we want to take advantage of Mr. Market. Now, the first time Mr. Market was mentioned was by Ben Graham back in the 30s and 40s. He wrote Security Analysis, and the Intelligent Investor has a partnership with Mr. Market. And Mr. Market is going to get overly aggressive, and he's going to be manic, and he's going to be overly pessimistic, and he's going to be depressed. Now, when Mr. Market is overly aggressive and he's manic, we want to be selling to Mr. Market. And every day he's coming into the office, and some days he's super excited and he's wanting to sell things to us or buy things from us at exorbitant prices because he's super excited. He wants to buy everything, and we're able to sell to him when he's overly excited. And then sometimes Mr. Market comes in the office and he's overly pessimistic. He's down on himself. He's down on everything. And we want to buy from him when he's overly pessimistic. And recently, over the last few weeks, we've been in a period where the Mr. Market may have been overly pessimistic towards some things. Maybe not all things. There are some things that may be still a little expensive, but there are some things that are definitely cheaper now than they were a few weeks and months ago. We want to take advantage of Mr. Market when he's overly pessimistic. So we can look back to previous sell-offs to see what may be a good thing to do. Back in 2000 and 2001, I remember Warren Buffett was sharing that he was buying up more shares of his own company. He was saying that Berkshire Hathaway looked cheap and he wanted to buy back shares, and that was a great time to buy Berkshire Hathaway. Lately, he has not been saying that Berkshire Hathaway looks cheap, so it's probably not the best time to be buying Berkshire Hathaway unless you want to have something that's going to hold up a little bit better on the downturns, because he is holding on to a lot of cash right now. I remember back to 2008, late 2008 and early 2009, and the baby was thrown out with the bathwater that period of time. And so it was a good time to even pick up bonds at super, super cheap prices. Bonds and preferred stock were going at super cheap prices. Those things rallied first, and then we were able to buy relatively inexpensive stock and good quality companies after that. In the pandemic, we saw a brief sell-off, and buying into just about anything worked okay. This time around, we saw the sell-off, and gold has rallied first, so buying gold was a great thing to buy when it was bottoming. Right now, it's at a new all-time high. Looking overseas in Europe may be the best thing to be looking at outside of the U.S. because overseas investments are much cheaper than U.S. investments right now. But it may be that we see the U.S. recovering as well. It's just unlikely we're going to see the biggest, most popular companies continue to garner the most attention and the most popularity going forward. So what we want to keep in mind is that we want to take advantage of Mr. Market, be greedy when others are fearful, and fearful when others are greedy, and look to buy when things are down. And as always, stay thirsty for knowledge, put those thumbs up, subscribe to the channel. Here's another video you may want to watch, and we'll catch up with you next time.